Chapter 14, How and When to Invest. This is part 1 of 3, a mini focus on investing. You will often hear me say that when you learn about the laws of money, you are also learning about the laws of the universe and the laws of nature. Here is an example. Admire the symmetrical, but invest in the asymmetrical. When two things are identical across a specific point or line, it's symmetrical. Humans love symmetry. We think it's beautiful. The asymmetrical, that which is not equal, too often is treated with hesitation. Recognizing the beauty of symmetry, but the power of asymmetry, is necessary for finance. First, some review. Anything that can be exchanged for cash is an asset. That old piece of pizza in your fridge is an asset. Even if you may only get 25 cents for it, as long as you can trade it for money, then it's an asset. If you are hoping that the asset may go up in value over time, the opposite of that slice of pizza, then we may call it an investment. Just because someone calls something an investment does not mean it isn't actually a scam. On the other hand, something can carry risk without being a scam. In those cases, we say the risk carries a reward. Thus enters the Securities and Exchange Commission, or SEC. A security is a legal investment with the possibility of profit simply by virtue of holding it. This possibility is endorsed by the Securities Exchange Commission, SEC, an agency of the United States government. When you hear security, think the money is securely located in a government-approved asset. The government is not guaranteeing you will earn the money, but just that it is safely stored or secured in a strange financial contraption with the possibility of profit. In case you are curious, the meaning of security in many ways came from the United States Supreme Court decision SEC versus W.J. Howe Company. Long story short, the W.J. Howe Company sold profits in their orange grove without selling the oranges along with them. The W.J. Howe Company should have registered their profits without the oranges with the SEC. Let's return to this law of money. Admire the symmetrical, but invest in the asymmetrical. Many securities are asymmetrical. The benefit of the reward is not equal to the pain of the loss. This can be a very good thing. Imagine you buy a haunted mansion. The chances for profit are huge. If you did ghost tours, you'd make a killing. But there's a chance the ghost will torment you for eternity. Maybe you'd become a ghost too, or something like that. The risk here is symmetrical. The possible profits on an actual haunted mansion tour are positive infinity. You would make unlimited amounts of wealth with this successful business. However, due to the risk of being trapped in the house forever, the losses are infinite too. Being bothered by a ghost forever, or turning into a ghost, or anything like that, is probably a cost you would happily and readily call negative infinity. Long story short, unlimited growth is canceled out by unlimited loss. Symmetry is not always helpful. In other words, don't buy the haunted house. Stocks and other securities are not this way. The risk is asymmetrical. To review, you give up your money to a company and they give you a piece of paper, aka a stock certificate. You lose cash but gain ownership in a company. This is a stock. The company wants your cash so they can hire more workers, invest in new products, and advertise more. All of the pictures of companies on the screen were owned or created by Facebook. Facebook acquired or created these other companies or inventions with the cash shareholders gave them. Facebook then gave more shares to consumers or saw their current shares increase in value when they made these purchases. If the company grows, your stock certificate entitles you to a percentage of that now bigger and more profitable company. There's no limit to the growth of the company. In theory, it can grow towards positive infinity. The lowest your stock can go is 0, While the company may go bankrupt, you, the stockholder, will never go in debt with stocks. The worst thing that can happen is your stock certificate is worth zero. This is not symmetrical. The risk-reward is asymmetrical, and that's a great thing. Now things get a little weird. Since the lowest certain securities can go is zero, but the highest is infinity, we can represent the potential for profits as positive percent signs. The crazy thing is, the more percents you bundle together, the higher the percentage goes. Think of it this way. Even if you do not like everything on the Thanksgiving dinner table, the more dishes your family brings, the greater the likelihood you'll end up satisfied even if you don't like everything. A group of stocks bundled together to decrease the risk of hitting zero and increase the likelihood of approaching infinity is called a mutual fund. A mutual fund is a group of stocks. Mutual fund, or mutual, means together, and a mutual fund is a fund made up of stocks put together. If you had a time machine that only went back 10 years, you could be a billionaire if you invested in the FANG mutual fund for Facebook, Apple, Amazon, Netflix, and Google. Let's explain mutual funds a little differently and why their lack of symmetry is just so cool. As you know, if you own a stock or share of Netflix, then you own a tiny part of Netflix. Let's say rappers decide to branch out into the breakfast cereal industry. Nothing is more impressive than a musical artist or celebrity that knows how to make a good breakfast. Gucci Grams comes out and their stock is selling for $1, and everybody expects this cereal to take the nation by storm. So valuers are expecting the stock price to go up to 100. However, no one expects the birth of 2 grains, and as a result of this competitor, Gucci Grams goes down to a quarter. Just because one company made money and one lost does not mean 1 year later both companies can still be more valuable than they were 365 days previously. Rather than put all of your money on one wrapper-based breakfast cereal, split your money across all of them. But you do not stop diversifying across stocks. While mutual funds may refer to groups of stocks, there are other financial instruments that capture the diversity among their asset class. Real estate investment trusts, or REITs, invest across multiple properties at the same time. You can also have government bonds, corporate bonds, convertible bonds, municipal bonds, and even junk bonds. You can also have unallocated metal accounts with gold, silver, and platinum stored hidden under the Earth's surface. The more diversified accounts tend to be, the more asymmetrical the returns. That's right, something lumpy tends to grow bigger. That is what made total stock market index funds so cool. First reference in Chapter 8. Bigger and bigger bundles of diversity become less and less symmetrical. Why? The more different something becomes, well, the less equal it is. Giant bundles of diverse asymmetry is not only the language of money, it is exactly what molecular biology would be if we change all the terminology. I think astrophysics is just the science of weird shapes bumping into other weird shapes that somehow give us weird colors in the process. So, to conclude, once you learn some laws of money, you end up learning some laws of the universe and laws of nature too. And a great example is admire the symmetrical, but invest when it's asymmetrical.